Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. And today we are going to be adding a diagonal spread to our example paper money trading account. And that's a strategy. It's an interesting one. It's actually a combination of two strategies in one, where a trader might be looking for growth and income. So I want to make sure that we go at a pace that everybody can follow. I'm going to be explaining how a diagonal spread works. We're going to be placing a trade, planning the exits, the full shebang. But before we can get to any of that, though, let me first of all say hello to everybody out there in YouTube. Great to see all the familiar names again. As always, hello to Alfian, Janelle, Chris B, Selva. Let's see, Life in the Fast Lane, David, JDLMI, Ricebird, everybody else. Thanks for joining us week after week. I always certainly do appreciate your attendance and your contributions to these discussions. There were a couple of names in that list that weren't entirely familiar to me. So if you are here for the very first time, I want to welcome you as well. Thanks for joining us today. I also want to let you know that if you're watching on the YouTube archive after the live stream has concluded, enjoy the recording. That's a great way to watch these webcasts, but you're certainly invited to join us in the live stream if you'd like to be here. This is a Thursday webcast series. We kick things off promptly at 11 Eastern time. It's always great to have new attendees here. Now, another thing I want to make everybody aware of is that my very good friend Brent Moore is going to be hanging out in the chats with us. Brent's going to be keeping an eye on the questions that come in. And if I can't get to those, Brent's there to pick up my slack. Thanks for having my back there, Brent. Brent and I have worked together for more than 2 decades. He brings a ton of experience to this discussion. Great to have you here, Brent. And Brent and I would also like to issue an invitation to everybody listening. We'd certainly encourage you to follow your favorite Schwab presenters on social media. So you can find Brent and me on X. You can follow Brent there at Brent Moore CS. You can follow me on X at Cameron May CS. Now you can also now find me on LinkedIn. Follow me there. You just go to linkedin.com/in and then /Cameron May CS will take you right to my profile. Give me a follow. But let's get into this. And of course, as we discuss diagonal spreads and options trading and all sorts of approaches to the markets, risk is real. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let's outline an agenda for today. Now, as we always do, the first thing we're going to do is look at our existing example positions. I don't think we're going to be making any changes to those, but there has been a change to one since last week that we need to talk about. Then we're going to take a quick peek at the markets, set sort of the stage for today's discussion. Then we're going to get into trading diagonal spreads, which really is a 2-in-1 strategy where a trader is looking for growth and income. Now, it's possible both of those could blow up in that trader's face. So we want to talk about how the trade might work, how it might fail, and how the trader might prepare for both of those scenarios. And then we'll plan and place the example trade. So let's go right to the Thinkorswim desktop platform. Here are our 3 existing positions. You'll notice there's a 4th that should be there. It's not there. We'll talk about where it went. But first of all, we have NVIDIA. This is a 170, 175 bull call spread. Bought the 170s, sold the 175s. The trader's preference here is for the stock to be above 175 as we move toward the 19th of December, which is in just 8 days. And right now we're at 177, so that sounds like it's going well. And yet somehow overall, we're down $200. And really all that damage has been done today, down $625, taking us from an unrealized gain of $425 to an unrealized loss of now $200. This is where the trader might be having to make some difficult decisions. Everything was looking good until this morning. Let's go to the charts and see what's going on there. With NVIDIA, just as a quick visual reference point, I draw these things in here. If you're wondering where the pink box and the green box and the lines and text are coming from, I just draw them on using our drawing tools down here. But in any case, we own 10 of the 170 long calls at this level, own 10 of the 175, we've shorted 10 of the 175 short calls, sold them at this level. So our preference is to be up here in the green, and we are there in the green, but just sort of hanging on. We were more comfortable as of yesterday and the days before that. Stock was moving in a more comfortable direction. Today, we pulled back, still inside the green, but now this 8 days ahead of us is starting to look like all kinds of danger, isn't it? This is what can happen. Yeah, we're going to keep an eye on this one. I'm not going to pull the plug on it. It's still where we want it to be. But it would be nice if we could get a little bit of upward momentum again. It's not terribly encouraging that we're breaking down a little bit here. Pardon me. But we're going to let that one work. Let's go on to our next trade. We have on Tesla, another bull call spread, different strikes, bought the 400s, sold the 410s. So we'd prefer to be above 410. So this one got a little more margin for error here. We're at 442. This trade is doing quite well. As a matter of fact, the best we can do on this $10 wide spread is to see a $10 distinction between our short strike and our long strike. And if you look at that right now, it's awfully close to that. It's over $9 at the moment. So for some traders, they may consider just exiting some, maybe a portion of their positions. We have 6 contracts here. Maybe they decide to just take the profits on all, and obviously we're operating on an assumption there. If we're trading good liquid contracts, the trader has a better chance to get out at the time they want to get out. But exit is never a guarantee, especially not at the absolute preferred price. Greg is saying, let's close this thing up. Maybe what we ought to do, I wasn't planning to do this, Greg, but I'm starting to consider it. There's about 87 cents left on the table here. Maybe we do wrap up at least a portion of it. Now, obviously, if we do, we're leaving some money on the table there, but we're also realizing the gain. In this case, that would maybe be around if we did, let's say, close out half of these positions. That would be realizing about $700 of profit, assuming we can get a quick fill here. I'm thinking about that. Let's go see what's going on with the charts. So here's what's happening. Bought those 400s, sold the 410s. We'd prefer to be up here in the green, and you can see much more comfortably in the green here. Even with 8 days to go, it feels like even if we start moving downward, there's a little bit more breathing room. It's true. Yeah. It can still collapse, though. Look how quickly this stock can reverse course once it gets a mind to do that. So what should we do? Sandman saying, listen to the Steve Miller Band, take the money and run. I don't know if the band's going to influence this decision, but how about we do that? Let's go. We're going to close out 3 contracts. I like to leave some in play just so we can talk about the consequences of decisions if it goes south on us, okay? So I'm going to right-click on this. Let's create a closing order, and we're going to choose the first option here that says sell 6 verticals. Well, we're not going to sell all 6. We're going to dial that down to just 3. So we're going to leave half in place. See if we can close out the rest. Let's say we're willing with a natural at an 880 and the mid around 920. How about we say, let's try to get out for $9. Okay, a credit of $9 is going to be the minimum acceptable credit that we'll submit here. We're trying to improve the likelihood of a fill. It's certainly not guaranteed. But as a matter of fact, it's starting to escape us here. What very commonly happens when we're deep in the money here, we get a wide spread between the bid and the ask price. And so you'll see these big differences between the natural and the mid, and they can move around quite a bit. So we'll see. $9 credit when we're, if we're seeing numbers down here under 9, it's not very likely that we get a rapid fill like right now. Let's see. Let's make it contingent upon getting at least $9. Let's click confirm and send. We're going to try to sell out of these 3 verticals, the 400, 410 calls for a $9 credit. If we can get that, that would close us out for $2,700 total, minus $3.90 in commissions, bringing a total credit back to the portfolio of $26.96.10 as our minimum. So Janelle says, can I get a reminder of what deep in the money means? Yeah, so if our strike prices are, in the case of call options, if we are well below the current price of the stock. In other words, let's say on our long call, we have the right to buy shares for much lower than the current price of stock, we'd say that that's deep in the money. So that's the terminology that we use. Let me send that order off. Look at that, immediately fills, probably due to that quite wide bid-ask spread. It very likely just moved in our direction, gave us a nice favorable fill. So we left 70 cents on the table for these other three contracts. That's $70 on a contract on a vertical spread, or $210 that we closed out. Could have potentially made another $210 on the ones that we closed. Hope that's what I said just a few seconds ago. I'll modify what I said if I didn't. In any case, yeah, left 210 on the table from those that we closed out. And that's a high probability outcome. Look at where we are. If the stock just gets a little bit more upward momentum, we might look back and sort of rue the day that we decided to take those profits when there were more potentially available. Now, if it collapses, we'll feel pretty good about taking those profits. In any case, let's go to our UNH trade. So this is a diagonal spread. It's the topic of today's discussion. Not this trade specifically, but that's the topic, the general theme. In this case, what we've done here is we purchased the 300 calls that expire in 736 days, and we've sold the 380 calls that expire in 36 days. Preference being for the stock to go up, helping out our long calls, providing potential growth in the investment there. But we're looking for income from the short calls. Typically, when a trader is selling options, they're collecting a premium, and hopefully that contract just expires worthless. So the best way to optimize this is for the stock to go as far above 300 as it can go without crossing above 380. So we're above 300, nowhere near 380. The problem is that the progress here on that $300 call has been slow. Overall, look at this. Tragedy. We're down $218 in unrealized losses on this diagonal spread. Except no, we're not. For those who've been watching for a while, you know that we're not actually $220 underwater on this trade overall, just on how it's currently constructed, because we already have realized gains on earlier incomes that we've collected on this diagonal spread. So here's what's going on with the diagonal. Here's our UNH trade. We entered the original trade back here. Bought some long calls, sold some short calls right here. Those short calls, the 360 short calls, have already expired for a 320 profit. We sold some 380 short calls for this November 21st expiration. Those have expired for a 250 profit. So there's been a $570, we're setting commissions aside, $570 of realized gain. We set that against the 220 in unrealized losses, and overall, actually, we're up about $350 on this trade since we've initiated. It's just not doing as well at the moment. Now, we had a plan that if we started to break down, we were going to exit. And then the holidays happened. I wasn't here. We didn't talk about it. The stock kind of broke down below support and then got right back up. And so now look where we are. We need to make another decision. Looks like we've been strengthening recently. There may even be another inverted head and shoulders here, which is typically interpreted as a bullish indication, especially if we can get back up here. Zal says, how do we keep track of the actual cost basis? So for that, I'll show you in just a second, okay? But what we do is just check the account statement. It's kind of like with your bank, you know how much your current balance is. Well, what was my balance last Friday? What were the transactions I made last month? You check your account statement. Do the same thing when you're trading. Yep. Okay. There's a history here. Anyway, so for now, though, the stock seems to be behaving how we would like for our long call. It's starting to make progress, but it's still well below our short call, that 380. So we're going to let that one just continue to work. And it looks like it's even improving as we speak. We were down about $220 just a couple of minutes ago. Now we're down $193. All right, so to go to Zal's question here, how do we check the history of trades that have already concluded? Because we actually have one. We placed a trade let me go to our archives for this webcast series. So if you haven't done this already, make sure that you're subscribed to our YouTube channel. This is where you can go join our live streams. You can also find playlists for previous webcasts. So click the subscribe button down below the video right now. It only takes a second. It doesn't cost anything to do that. But if I go to playlists and scroll on down toward the bottom, we have a lot of different webcast series on a range of different topics relating to trading and investing. Here's the series playlist for this webcast. And let's look at the full playlist. And last week we talked about placing a quick strike bearish trade while the broader markets are still trending higher. So we tried to be strategic in placing just a quick vertical spread. See if we can get in and out very quickly before the markets have a chance to make up their minds and possibly advance higher. And that trade has already concluded. So let's see the history of that trade. So Zal, this is what we would do. We go to the monitor, not our current positions, but we go to the account statement. And right here, we can set the time frame to check a number of days back. And here we can even sort by symbol. So this allows us to see, here was our trade that we placed during the webcast last week. And we had a plan that we put into action last week where we bought this vertical spread for $1.80. We had a stop in case the trade didn't work out. We had a target in case the trade went well, and we actually closed it out, bought for 180, sold for 230. That's a 28% now realized gain. And that happened in 5 days. So could we call that a quick strike trade? Yeah, I think we accomplished the objectives of last week's discussion. So here's what happened with Amazon. Bought the 235 long puts, sold the 232.5 short puts, creating a bullish long put vertical spread where we'd prefer to head down. So let me zoom in a little bit here so you can see this a little bit more in detail. So we took the trade here, and the stock actually went down for just a few days. That's all we needed. We hit our vertical spread target for that 28% profit. Now we've recovered since then. So we were in for 180. Out for 230, but this was a $2.50 wide spread. This is what I'm talking about with regret. Look where we are right now. If we can just go one more day, still below 232.5, we left $20 per contract on 10 contracts, $200 of additional profit that might have been achieved if we can get still in the money at expiration. And it looks like we're going to get there. It could change. I might be wrong, but it looks like we might get there. Yeah, that would be interesting to follow up on that. I probably won't, just so you know. I'm probably not going to look at this trade again. But still, sometimes we leave money on the table, and it's not actually to the trader's benefit. It's nice to have the realized gain, but there was still more profit potential there. Anyway, so does that mean I made a mistake? No, I made the decision that I did. I just like to talk about the pros and the cons of those decisions. Not always good, even when we have a profit. All right, anyway, so now it's time to plan and place a new trade. And I don't want to do that necessarily blindly. Let's say that our trader trading verticals and diagonals, they always take the moment to first of all see what's going on with the markets, to see what sort of conditions we're trading in. So I'm not going to spend a lot of time on this because the S&P, yeah, it's right up there at, or it's very near, not at, but very near all-time highs. Stocks have had a great run since April. They've continued that run. We've been trading mostly, not exclusively, mostly bullish trade examples for this time frame, and the markets have cooperated. If we had placed those same trades when the markets are going down, it would have been tough to make the paper money profits that we have. So just realize that just because it's gone well doesn't mean it had to go well. Could certainly have gone the other direction. But yeah, the S&P just has been strength on strength. It's trading just below those all-time highs. Let's say that our would-be investor looks over these last few weeks and they see the S&P has run up, and there might be a concern here that it would then pull back, but maybe it's blown off some steam here in a different way. What might we call this? When a stock or an index runs up sharply, but then kind of drifts sideways. That's a bit of a bull flag. For some, they call this a bull flat. It's like a flag in a stiff wind, where the flag price action is mostly flat. But in any case, if we see that this way, a typical assumption would be, well, after this sort of sideways behavior is done, maybe we're set to go for another run. Yeah, Chris B says bull flat. Yep. Let's say that that's our trader's outlook and they're planning for a new trade. Are they going to be bullish or bearish? Let's say that we're going to do another bullish position. Surprise, surprise. Now, we did a bearish trade last week. Actually, with the couple of bearish trades that we've done during this time frame, we were able to just squeeze in quickly some quick profits that could have gone differently. Anyway, so let's plan in place a new bullish diagonal spread. Now, a diagonal spread, if you're not familiar with it, it involves buying a call, which is typically done when we're seeking strong growth, but also selling a call, which is typically done when the trader is looking for income. So we're looking for growth and income from this strategy. Yeah, Janelle says the bull flag is bullish. That's exactly right. Exactly right. Yep. But let's use an example stock for today's discussion. Actually, I considered a few. With a typical diagonal spread, not every diagonal spread trader does things this way, but they might look for a stock where they see substantial upside potential. It might be because they think the sector's doing well, but maybe it's just from what they see on the chart. All right. Now, there are some diagonal or bullish traders that look for stocks that have already been going up and up and up and up, and they're just hoping that trend continues. But there are others who might be concerned, boy, if something's gone up a long way, maybe it gets harder for it to continue that without taking a breather. So let's look at, there are some. Let's look at stocks like Johnson & Johnson. This has had a big run to the upside. Johnson & Johnson isn't one of those that some traders might traditionally discuss as, a big-time growth candidate. Doesn't typically fall into those fundamental categories. But this is a stock that's actually gone up 50% this year. It's been making higher highs and higher lows, and that's really continuing right into today, where the S&P isn't doing a lot today. Johnson & Johnson's on a big run. What about a stock like Walmart? Another company, kind of one of those staples companies where it's not in staples anyway, but you get what I'm talking about. Recently still advancing higher. And for some traders, they prefer these sorts of setup scenarios on a chart. But for others who are concerned about the stocks that are already trading at all-time highs, they might look for something that looks like it's just recently showing signs of strength, possibly conceptually giving it more upside wiggle room. We'll see. But an example of that might be like Visa. Visa is a stock that was actually until recently going down. But what has it done just over the last, let's call it month and a half? We have a higher high, a higher low here. And with today's action, we've accomplished a higher high. So let's say that our trader might be looking at something like this or something like Home Depot. Very, very similar. You can see it's been coming down. We hit higher lows and now moving to higher highs. Which one should we trade? What do you think? Let's set up a trade scenario. I think what we'll do, let's look at, here's maybe a potential tiebreaker. If a trader is struggling to decide between two stocks that may be technically sort of a dead heat, maybe they could just go look at the options and see which seems to have the options that have the narrowest spreads, the most liquid options. So I'm going to do a little comparison here. Let's say that in both cases, our trader sees potential for the stock to run for several months before hitting previous high levels. So maybe they're thinking of going out and buying a call for 4 or 5 or 6 months. Let's say 6 months. Let's go to the trade tab. Let's look out about 6 months. That would be out here on the 18th of June. And I want to look just quickly. This is very common with longer term options as we look, let's say, a little bit deeper in the money possibly for buying contracts. $2 or $3 between these bid ask prices. That's about, on a $30 stock, maybe around 10% on a $30 contract. Let's look at also Visa. Let's stick with the same expiration. Look maybe in the money. And you know what? They're not too dissimilar. Looks like maybe Visa might have a slight advantage here. Janelle's saying, let's arm wrestle. What do you think? Looks like there were a lot of votes for Visa anyway. Some votes for Home Depot. How about we just go ahead with Visa? So let's put together this growth plus income trade. So going back to our Visa scenario. So here's Visa just starting to stair step higher. Let's say that our trader thinks maybe with this new momentum, possibly we could ultimately challenge all-time highs. So if we were to buy a call and we did that, think about this. If the stock moved from 340 all the way up to 370 or 375, maybe, I'm not saying it's going to, but it may be, that could potentially make a lot of money. So let's buy a call in the effort to do that. Now, the trader isn't necessarily thinking we're going to shoot right up and be there by next Tuesday. Let's give it some time. That's why I'm looking at maybe the 6-month contracts. So the first element here is to buy a longer term long call. And which long call might we buy? Well, we could buy at the money. Here's the trade-off, as always. If we go deeper in the money, it costs a little bit more, can cost a lot more, but, and that's going to lower the leverage of the trade. Spending more money is going to lower the leverage of the trade, but it also slows down the impact of time. It also allows the trader conceptually to buy the stock at lower prices. So there are advantages to going in the money. Disadvantages is the contracts are more expensive. How about for our trader here? Let's say we go, maybe $10 in the money. How about we look at buying the 330? It looks like it has a spread of about 60 cents. That's actually significantly better than what we saw on Home Depot. So here's going to be our diagonal spread. It starts with, and this is going to be our example strategy. Let's make it bold so you can see it. It's a long diagonal spread. Actually, let's make it specific, a long call diagonal spread. We're constructing a diagonal spread using calls. Go. And it begins with conceptually buying a call. So we're going to buy the 18th of June, let's say 330 calls. And we'll look at that trading between 30.70 and 31.35. Let's just call it $31. Let's see if we can get filled for somewhere around there. Obviously, when we buy a call, what we'd like to see is the stock to just go higher and higher in price. If the stock keeps going up, that's potentially adding appreciation to the value of this call. The further it goes, the better. Now, when we buy a call, here I want to indulge in a little bit of best case scenario. We all have this fantasy in our heads that we're going to buy that call on a stock that just goes up and up every day for the 180 days or whatever there are in the contract, where it's just delivering growth for day after day after day. That just doesn't happen. It can happen occasionally. Look at what Visa's done a few times this year. Do you think there were any long call owners that were just shocked by the production of those contracts here or right here? So it can happen. It just isn't typical. More commonly, a stock will move in sort of a stair-stepping pattern on its way either up or down, very much like what it's done very recently. So during the times when the stock is running up, that's great for this growth. At other times, though, as the stock is pulling back, maybe that's an opportunity for a call trader to seek some income. So here's what we're going to do. We're going to sell a call at a level where the trader just doesn't think it's likely that that call will be assigned. All right. How about we look, let's look at our chart here. Maybe up here around 350. I'm trying to envision, I'm a little dubious. I don't really expect, let's say we were to sell a call up here around 355. and let's take that out here to January 16th. Okay. I don't know if we're going to get much of a credit there. I haven't looked at the option chain. I'm not sure. But a trader who owns a long call, they might see, oh, in the short term, we could run up before we really start bumping our heads into previous areas of resistance. So that's great for growth if that's what happens. But with that same logic, maybe we can sell a call up there and maybe collect some income that's unlikely to ultimately get assigned. But I don't know if there's going to be 355 credit. Let's go have a look. Let's go, first of all, let's look at a contract for the 16th of January. Let's just say that our trader prefers, and this is something I do in this webcast series pretty commonly. I'll stick with those third Friday, the traditional monthly expirations. They just tend to have stronger liquidity than the weeklies. Now, there are plenty of weekly contracts that have good liquidity, but they tend to be only on the most liquid stocks out there, Apples and Amazons and those kinds of stocks. Visa, pretty liquid stock, but its weeklies, I would suppose, are probably going to have a little bit wider spreads. Not always the case, but let's just say that we're going to look at the 16th of January, and I'm going to look at the 355. And you know what? Actually, what's available there? 279 to 305. That's close to $300 of potential income against the $3,100 that we've spent on our trade here. That would be around 10% of income potential against that investment. So how about, I think I might do that. 355, yep, that's that level. So let's add the second element of our diagonal spread, and then I can explain why it's called a diagonal spread. The two ways that it can deliver potential profits, but also we need to talk about how it might lose money. So let's say we sell the 16th of January. And by the way, for this June contract, it's not the 18th of June of this year. It's obviously the 18th of June of 2026, just to make that clear. I don't know if that's necessary. We all know it's June. It's the next June cycle. Let's just leave that alone. We know the 16th of January of 2025 has already passed. So let's go with the 355 call. And maybe, how much can we get? It's close to maybe $3. I don't know if I want to be that generous. It's not. Well, let's use the round numbers. Let's assume we can get $3. We might not be able to. But in any case, let's say there's our trade. So buying a long call that's longer term and selling a short call that's shorter term creates our diagonal spread. So why do we call this a diagonal spread? Well, it's because there are two differences between the long call and short call. First of all, we have time. This one expires in June. This one expires in January. So one expires short term, the other one expires long term. So there's sort of this horizontal distinction between the two if we think of time being linear. Now there's also price. We have a higher price and a lower price, higher and lower, sort of vertical distinction. So if we take a point that's horizontal and a point that's vertical and we connect those two, it kind of paints sort of a diagonal picture. That's the way that I think about these. That's why, at least my logic for why they call it a diagonal spread. And the spread also just referring to the fact that there's a difference in the strike prices. It's a call spread because we used calls to construct it. And it's long because when we buy something to initiate a trade, we say that we're long. And yes, we bought something and we sold something here, but we spent a whole lot more than we collected. So net, it's a debit, it's a long trade. Does that make sense? All right, so here's what we would like. Noodlebrain says, but if you get assigned, you could lose $300? That's a good question. The premium collected is not actually up for grabs. Nope, that goes in the account, and we decide what can happen with that. But let's talk about what could happen from here. Here's what we would really like to do. Let's talk through the preferred scenario, okay? What the trader would like is for our stock to go up. Imagine what's happening to the value of that call that we own if our stock is going up. It's going up in value. We're getting growth. But where we prefer to wind up, and this is really absolutely best case scenario, is just below 355. So if we've gone from, let's say, around 340 up to around 355, that long call is having a great time. However, if we get to the January 16th expiration and the stock is below 355, someone out there has the right to buy shares from us for 355 that aren't even worth that much money. At that point, they maybe say, Cameron, keep my $300. I don't want to pay you $355 for the shares. The trade's done. So in that case, we've gotten growth from our long option, and we have a realized income gain from the short option. So unrealized profit on the long, realized profit on the short at expiration. That's what we're looking for. That may not happen. What if we overshoot the mark? What if the stock goes up here? Stock's up there at 360. We're getting above 355. Uh-oh, we didn't intend for this to happen. Well, our long call still having a great run. The short call, though, is starting to chip away at the profits on that long. As a matter of fact, if we overshoot by more than $3 at expiration, the short call is going to start to incur a net loss, and that can be applied against the unrealized gains of the long call. In any case, for the trader here, if we start to get above 355, there's a risk there that well, it's always present, but as we go in the money, there's a stronger risk of assignment on that short call. Assignment being someone has the right to buy shares from us for 355. Maybe the trader doesn't want to sell any shares for 355. So in this case, maybe the trader just decides, let's buy out of that contract. It might cost us more than $3 to do that. So in that case, we're not losing $3, we're losing whatever the net cost is beyond what we received of $3. So if it costs us $4, we lost $1. If it costs us $5 to buy out, we lost $2 on the short call, which sounds like a tragedy, but the long call is having a great day in the sun. The stock has already gone up from 340 to, let's say, 357, 358, 359. That long call is way more profitable than the relatively meager losses we're taking on the short in that case. This is a bullish trade, and as long as the stock is behaving bullishly, the trader should be in good shape. Now, what if the stock goes down? That's not what we want. If the stock starts to go down, well, we're a long distance from being assigned or having that elevated risk of early assignment of the short call. Still possible. Even way out of the money contracts could be assigned. It's just not very likely. Okay. So if the stock is going down, great. Looks like we're going to realize a gain on this income, but we're not getting any growth. As a matter of fact, we're getting negative growth. And how much could we lose if the stock just collapses in value and we let it go all the way to that June expiration? We could lose the $31. So that's why the trader, if the stock is going up, we're not really worried about it. Not very much. Assignment, we might even have to deal with that if, someone decides to buy shares from us and we wind up short the stock, which if we sit on that, has unlimited upside risk potential. But upside is not really the concern. Down is the concern because we don't want to lose this investment. This helps out a little bit, but it's limited. If we lose more than $3 on this long call, now we're in a loss territory. So the bottom line is if the stock starts to fall, if it starts to look like it's not going to grow by June, trader might just want to pull the plug. All right, so we'll keep an eye on that in future webcasts. But let's go ahead and place our trade. Let's piece this thing together. Here's how we might do that. So since we're here in January, let's prepare the sell order. So I'm just going to go to the 355 strike and click on, it looks like we're going to get even more than $3. Let's click on the bid price, and that creates a sell order. There we go. Default is for 10 contracts. We'll try to keep the total amount invested to about $4,000. Might just be one contract, maybe two. Should we do two? Maybe two. Anyway, so there's our short contracts. Now, let's go to the long contracts out there in June. And I'm going to hold down the control key on my keyboard and click. Look at this. This has even gone in the money now. Let's click on the ask price. Collecting more on the short, that's nice, but we're going to have to spend more on the long because calls have just gone up in price in general since we started talking. Let's hold down the control key on our keyboard and click on the ask price. And what you'll see is that's now created a diagonal spread. All right. Eric says, what would be reasonable risk management? Well, the trader has to make that decision for themselves. We have to realize that whatever we spend net on this trade is the maximum theoretical loss of this trade. So if we did one here, looks like that might be somewhere between $2,800, $2,900. I think for this one, let's do two contracts. Yeah, it's going to be a little bit more risk than we typically take, a little bit larger investment, but I don't have an intention of sitting around till June watching this bleed to death if it's going down. Okay, so we're going to try to minimize that loss exposure. In any case, there's our diagonal spread. Let's say with the mid around 28.13, let's say we're willing to spend more than that to get into this trade. How about we say 28.75? There we go. I'm going to set that as our limit order. Let's click confirm and send. We're attempting to buy two of these diagonals, the 330, the June 330s, the January 355s, for a maximum debit of $28.75. There is a commission to be paid here. That could increase the total cost of the two contracts to $57.52. We're just saying that's the most we're willing to spend. And let's click send. There we go. And actually, we bought that for actually $28.05. With these wide spreads, we got a pretty favorable fill. That's it. But let's see, question came in, if you get a sign on the short side of the trade, would you have to close the long to fill the obligation, or could you pay and roll and keep the long sides? Great question. If assigned, let me just summarize that very quickly. Assignment means somebody bought some shares that we didn't own. This is technically a covered position. However, exercising the long is almost never the best mathematical exit. In that case, what we probably want to do is buy the shares back on the open market to cover that short position. And then either maybe we sell that long contract or we just hang on to it. We'll talk about that in future webcasts. But guys, we have accomplished what I set out to do today. I wanted to talk through a diagonal spread, which for some traders is known as a two-in-one strategy, looking for growth and the potential for income. But there's certainly risk involved. So we have to manage both sides, prepare for both potential outcomes. For now, we'd just like to see our stock to go up as close to 355 by January 16th as possible. That's what we're looking for. We'll see how this plays out. Hopefully, you'll be able to join me in future webcasts or watch the archives for those to see how this thing goes. But thanks for giving me your time today. Time for me to let you go enjoy the rest of the webcasts that we have on slate for the rest of the afternoon, or the morning and afternoon. But as you do, make sure that you're taking advantage of the full slate of educational resources made available to you from Schwab Education. So first of all, if you haven't done it already, subscribe to our Trader Talks channel here on YouTube. Just go down and click on the subscribe button. It only takes a second, but this is where we provide the ability to join our live streams. You can also find the playlist for previous webcasts. Another suggestion that Brent and I have for you is to follow your favorite presenters on social media. So you can find Brent and me on X. You can find Brent there at Brent Morris CS. You can find me on X at Cameron May CS. So there's my handle. And I post here frequently, and if you reply to one of my posts, I reply right back to you. I don't know the exact percentage of posts that I reply to, but it's well north of 90%. Every once in a while I'll say, ooh, somebody made a comment. I can't touch that. I'm just going to leave it. But yeah, if it's on topic, if it's a good comment, I reply back to those. In any case, Also, you can follow me on LinkedIn. Go to linkedin.com/in, and then my handle is /CameronMayCS. That'll take you to my profile here. Give me a follow. This is just something new, and I do post here. Like you can see this video. Janelle, I saw that you were commenting about this video. Like this one. It's a new sort of trading technique. Not new. This may be new to some people. In any case, yeah, check that out. Everybody, thanks for giving me your time today. Brent, thanks for helping out. Thanks to everyone that's already clicked the like button. That's always appreciated. It helps. It gives us a boost in the YouTube algorithm. I will see you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.